Sandeep Bhatia, Managing Director and Head of Equity India at Macquarie Capital, with us on the show. Sandeep, it's been a really long time. Neeraj here. Thanks so much for taking the time out. Hope all is well.
All good, Neeraj. Nice to see you. Nice to talk to you.
No, likewise, Sandeep. Sandeep, I'd love to understand what is it that you tell your clients when they ask you about what to do in a market like India currently, which optically is trading at expensive levels. So is it go bottom up instead of being top down? Or is it some other strategy that you would advocate?
So, I think the best way to characterize a market right now, the Indian market right now, is to say that this is solid top down, but a stock pickers market from here on. I think what is helping India is the fact that India is the only high growth market which has political certainty. We saw the French elections come through on the weekend. I think that probably is a gridlock as far as the French Parliament is concerned. We are heading into an uncertain phase for the US political calendar. We don't even know whether the current Democrat candidate, will remain the candidate for the election. So there's clearly a lot of uncertainty politically across the globe, and India has moved past its election cycle and is now essentially focusing on driving growth up, which is why it should be a stock pickers market and a bottom-up stock picking cycle.
Sandeep, do you guys, I mean, the updates that have come out thus far, save for some consumption names, staples names rather, have been sluggish, if you will. I mean, maybe Bajaj Finance did okay, but banks by and large, very iffy, Titan iffy as well. Do you reckon numbers can make up for the earnings expectations that are there and give the valuation support, or are you circumspect on the valuations at which Indian markets are trading at currently? And of course, your view on how do you guys as a house expect earnings to be like in Q1 or for FY25?
I think what you're really raising a valid point. I think one should be very circumspect for the market always. The past performance, no indicator of future performance. We know that line everywhere. I think the real challenge from here on is not to look at only the, I said Bajaj Finance or HDFC Bank or any of the large consumer staple names. I think growth there is not going to be be a big positive surprise. I would be happy if they continue to deliver what they are supposed to deliver. Therefore, the stock picking has to happen in the sectors which are outside the favorite. So we definitely like the capex story, which is panning out. We like selected pharma names. So that's where the stock picking skills will come through. In the near term, I think the only thing that can be a positive or a negative surprise both ways, it will be if anything comes up in the budget on the 23rd of July. But other than that, it's going to be individual stock selection.
Got it. Okay. Just before we get to that, Sandeep, I have a fundamental question. Everybody's been toggling with the question of whether the budget can balance out the troika of three things, which is focus on capex, stick to the fiscal glide path, or better it may be, and at the same time manage a little bit of focus on consumption that might be needed while giving out the partner states the kind of numbers that are being spoken about. Now, my question is, do you reckon it will be a tough choice between the three, or can all three be managed with the finances and resources at hand of the government?
Exactly the question which we discussed today morning in the morning meeting here. Now, I think the last bit, which is the partners' demands and in terms of central support, I think the only thing that logically should happen, given that no spending can happen overnight and it takes time, these demands cannot be met in full. So many times it's a political bargaining point. So we have to remember that. And second, even if support is granted, it has not to be granted because Rome was not built in a day. So any capital city or any support that is needed will take a couple of years to get built out. So it can be staggered. So I don't think the whole quantum, neither the period in which this support is given should be overestimated as being short or very high amount of support. If that is what is done, that's a good thing. The glide path, the fiscal glide path, now that's the most important thing. I think structurally, India needs to have lower interest rates on a sustained basis, lower inflation on a sustained basis. That requires fiscal deficit to be brought under control. We did not give up on fiscal rectitude even during the COVID even during the COVID period. While the problems which of inflation and high fiscal deficit which US faces or large European economies face are because of what the overspending which happened during the COVID. Now, whether the election outcome can change that, I don't think it should, and I hope it won't. So that's it. I think we just need to hold our breath and do what we have done till now, and continue to doing that and move in that direction. The demands of the coalitions of partners can definitely be met over a period of time.
Okay, so Sandeep, would it be consumption versus capex, or do you think, from a market's perspective, it'll have equal stuff for both?
I think it should be more capex and fiscal rectitude. Consumption actually happens organically if there is confidence in the economy, if there's job creation, and if there's inflation under control. Consumption, otherwise, if it is given a steroid shot, is a boost. We don't need that boost. We just had the election. Even in the budget which was presented on 1st Feb, of course, at that point in time, there was overconfidence to some extent, I would say, that there will be no political challenge given the elections which are coming. So there was no real big consumer push which happened at that point in time. I think now that the elections are behind us, we should continue to go down the fiscal glide path and build our reserves in terms of fiscal space if we need to spend later, rather than use that right now, which is just both fiscally irresponsible and politically not wise.
Okay. Just one follow-up, Sandeep, on consumption before we take that break. The Q1 updates that have come out thus far, I mean, Marico saying that the numbers are okay, and through the year they might expect the numbers to improve and gross margins to expand. Dabur saying a similar thing. Adani Wilmar numbers not too bad either on the Q1 update. Could we finally be seeing staples make a comeback, or is it too difficult to call that from a market's perspective?
The staple comeback, even if it is happening right now, is not going to be something which will be eye-popping, is the way I see it. It's going to be better than the worst expectations which we had in the last couple of months, but not better than something which is happening in other sectors. So that's how you should position it. It's not going to be in a hurry and overweight sector in a portfolio sense.
I want to ask Sandeep about his thoughts on banking. Let me quickly get in my colleague Harsh for a minute to try and tell us about the banking updates as they've come out in the last 4 or 5 sessions. Harsh, over to you very quickly.
Well, yes, so just a couple of stocks which are, really standing out in terms of their numbers, Neeraj. First off, want to talk about Bank of Baroda contraction both on the deposit side as well as the advances side on a sequential basis. Not a deep degrowth, but nonetheless 2% degrowth and just about an 8.5% kind of growth number. So nothing impressive even on a year-on-year basis when you're looking at numbers, obviously, because there's been a contraction. Also on the deposit side, in all fairness, Bob grew extremely. The base was high. Q4 FY24 was very strong in terms of growth, and therefore maybe that also to be kept in mind. But nonetheless, the stock down 3% on the back of the kind of numbers that it's posted. Also, the other one on the smaller finance bank side, AU Small Finance Bank in focus. Now you're looking at good growth on the advances side, 4.9% sequential, but on the deposit side of things, again, you're seeing a bit of a contraction, so some pressure coming in. CASA growth was there, but nonetheless, overall deposits contracted, which is why your LDR has now come to 93%. This will certainly restrict growth for AU very likely going forward. So that one also not reacting the best in trade today on the back of those. So LDR largely in focus, Neeraj. Now, of course, as the earnings start to trickle through, margins will also come into focus.
Got it. Thanks, Harsh. Thanks for that. Sandeep, What did you make of banking? I mean, there was a bit of a rush, not, I mean, in HDFC Bank and some others on the hope that things will improve. Q1 is seasonally weak, I understand. Is it weaker than what you thought?
Yeah, I would want it to be stronger. So the short answer, yes, it's weaker than what I would have expected it to be. We'll wait. I mean, people are saying the heat was too much, therefore, whatever. I don't know. I think I want to see one more quarter or so. I don't see this a structural problem with banking, but yes, it could have been better.
Okay. So, Sandeep, therefore, if the biggest leg or biggest weightage of the market hasn't come out with the best of numbers, what makes up for that disappointment? Could it be tech? Would it be energy? What makes up for the disappointment?
So, given the importance of the banking sector, if it doesn't perform for the full year, we are extending this to the full year, then I don't think it makes anything else can make up. That's the short answer, which is again goes back to the first sentence and the first part of our interview, where it has to be a stock picker market. To expect the market to deliver, headline Nifty, from here another 15% plus, double digit plus, requires a much broader, stronger, earnings growth story, unless you continue to re-rate. And re-rating can happen because of fund flows and so on and so forth. But per se, nothing can make up for a shortfall if there's a full year shortfall in banking, is the answer.
Wow. Wow. So, okay, we need to watch out for the banking results and they need to come out in a good fashion in order for the FY25 earnings numbers to look solid. Remember, we had 4 double-digit years. Let's see if we can do that. The market's currently penciling in that. Can IT do the trick, Sandeep? I mean, a lot of hope built in after Accenture's numbers that maybe Indian IT could turn the trick as well. If there is a Trump presidency, can BFSI make a comeback and therefore will it start getting discounted? Just trying to understand, how are you guys thinking about it?
Yes, IT is something that we have liked. We like specific names there. Whether it's a Trump presidency or a Democrat candidate presidency, impossible to say now. I don't think anyone in the US can take these political bets right now. I would just focus on one thing as far as the US is concerned, is whether that it has political stability. Even if we have a presidential election, it may still not have political stability. And that would play out across the globe if there's political uncertainty in the US. I think we have started, we have all through this year just cut the number of Fed rate cuts that can happen. And if there is political uncertainty, to have another big rate cut cycle and a big boost to the economy may be difficult for the Fed to give you. So let's wait for the presidential elections. IT is definitely at the margin better than what one thought. And therefore, that's the way I would play it. It cannot be the driver for the entire market per se, both in terms of earnings or headline indices.
Sandeep, you would have some thoughts on this. I mean, some of the mid-sized IT names, right, are telling us that maybe they're a bit more nimble, maybe they are able to get some generative AI deals. The ER&D businesses are actually talking very big. KPIT is on record saying that they can be 3x their current size if they continue doing the work that they are. So ER&D, smaller IT services, product companies, etc. Can that lot do better even if large cap IT finds it difficult to show in very high growth?
Yes, of course. That's the reason why we like Persistent. And that's what I think is what we have to build when we look at stock picks. So clearly, this IT sector is something which will have individual names which can buck the overall, Fed rate, US presidential cycle, Trump coming and boosting the economy by tax cuts. All that can be bucked if you are in the right set of names. Because they have other organic business drivers.
Okay. A point well noted. Now, just one follow up to the IT, Sandeep. Last 2 or 3 questions. The tech businesses or the platform businesses in India, and there are a bunch. I mean, suddenly a TBO Tech came into focus. We know what Zomato has done, PB Fintech has done, etc. Not a very wide bucket, but about 7 or 8 or 9 names out there. Are those businesses looking interesting to you, or is not that wide a bucket for you to track?
We track some names. We have been concerned on valuations which are baked in these names. And these names, therefore, to continue to perform from here on, require a great presidency to happen, and a broader bullishness about the entire tech sector and so on. Though they are not directly playing on that market per se, it requires a major tech side bullishness to continue to happen. But we have been concerned on all these names on valuations.
Okay. So there is a concern on IT valuations. Banking numbers are not quite coming up. Energy, Sandeep, can that do the trick, or is it too volatile to predict?
So Macquarie is an energy house, right? So I think energy is going to be good as long as global growth is good. We expect global growth to hold up, so energy will be good, is the way the thought process flows. I think all these names have multiple stories. So if there's green energy happening, that's the good. And nowadays, with what's happening in the elections, a Trump election or even the European elections show that some of these climate change pressures are actually reducing. So even carbon energy is doing well. So energy is definitely something which both green and carbon generated energy both are definitely good spaces right now. And I think the politics in the West is veering away from this extreme leftist kind of politics which has dominated for more than a decade in those regions. And therefore, some of those, unfortunately, some of those pressures on cleaning up the energy cycle is definitely abating, which is why both green and traditional energy names will do well.
Okay. Okay, Sandeep, my final question, because you guys are not just an energy powerhouse, such a great view on commodities as well, and it's a question that has perplexed many. What to do with industrial metals, considering that China recovery is flip-flop. The third plenum as well, not quite expected to really throw out big bang measures either. But a round of EM fund managers that Bloomberg interviewed seem to suggest that they are betting on China because some recovery would happen. How are you thinking about this? And is there a bet to be taken on commodities and commodity stocks for the second half of the year?
I think very good question, Neeraj. So I would say two things. The China bet, which fund managers are taking, is a financial bet. It's not necessarily an economic bet. Financial bet because it's underperformed, its valuations look good. It's the second largest economy on market currency terms and largest economy on purchasing power terms. So you cannot ignore China. So that's a financial bet which fund managers are taking. On the flip side, we know that India is expensive. So I think metals, the view is that as global growth is holding on. In fact, global growth has surprised for most part of this year. And China, they will not allow the metals cycle to go completely out of hand. So the government and the producers will control the supply of metal and will ensure that the prices remain remunerative. So there's no big dumping which is happening per se, though there's a significant overcapacity and issues in China. So on that basis, Indian metal names can also do well. So that's the thesis. The thesis has two legs to it. One, the global growth remains in green and remains in 1.5 to 2.5% global GDP growth range. Not too hot, not too cold. And China manages because finally everything is controlled in China, and the metals companies will not create a price collapse.
Sandeep Bhatia, so good talking to you today. Thanks for taking the time out and being with us.
Thank you. Always a pleasure. And fantastic interaction and a great pointed question. Thank you.
Thank you so much. Thank you so much. Well, that's the view from Sandeep Bhatia of Macquarie Capital on a range of issues. We call it a day on this leg of Talking Point on the note that the markets are flat. But stay tuned. Lots more coming up on NDTV Profit.